Okay. Thank you. Welcome, everyone. We have some great guests today. So I'm Brendan Walsh. You might know me when you call into the phone. We're actually getting 2 new salespeople started up. So be nice to them. Be friendly if you're in the crypto space. Nick and Tristan are going to be starting up soon. But you might have seen me in previous crypto webinars. And one of our most successful ones that we had was on crypto IRAs and crypto taxes. We had someone that represents, people in tax court on that last one. David is actually helpful in getting us in a relationship with that person, starting that conversation. And David and Jordan work at CryptoTax.Trader, and I believe you're working on a new brand called Coinledger. So David, could you take it away and explain a little bit about CryptoTax.Trader and Coinledger?
Yep. And that's exactly why we're rebranding, because it's hard to remember. It's actually CryptoTrader.Tax, exactly why we're rebranding the business. But really, we're cryptocurrency tax software. So as a lot of people on this call know, if you're deep in crypto using multiple platforms, Coinbase, BlockFi, maybe in some DeFi protocols, quickly it can become hard to just simply track how much money you're making or losing. And so CryptoTrader.Tax is a product that integrates with all of the platforms that you're using. We can suck in all that data, normalize it, and then we can report on it for you, tell you how much you're making, how gains, losses, and give you your income in kind of fiat terms, which of course is what you have to report your taxes in. We've been around for about 3.5 years, and we're really excited about the new product, Coinledger, that we're launching end of November. So I started the company about 3.5 years ago, and love the crypto space.
Awesome. And we'll get Jordan to introduce himself in a second. I've used your guys' software to report my own taxes on TurboTax. And just to answer a question, people ask, like, why do you bring tax people on an IRA side? So many of these customers have questions when they're on the phone with me. Some of those I have some knowledge to answer. Some are honestly beyond my pay grade and the more in tax advice section. So we try and bring, say, hey, our customers have a need for this. There's really not a lot of experts that know taxes and crypto at the same time. So Jordan, why don't you introduce yourself and take it away?
Yeah, no, thanks, Brendan. So my name's Jordan. I am a recent addition to the Coinledger team to help kind of integrate some things with a lot of, DeFi protocols and NFT projects that they've been working on, doing a great job. I've used the platform before while it was CryptoTrader.Tax, obviously before the rebrand, with a lot of clients that have had similar issues where they need to figure out where they stand from a tax perspective. And it's a great software, of course, but what I do on the CPA side is really kind of supplement that sort of software solution when there needs to be manual entries that need to be reconciled, when you need to have some sort of human support, and you have a CPA, a tax professional that can do that. And I've been doing that since 2017, really during that first major bull run that brought a lot of people on board. Of course, there were bull runs before that, but that was like the first mainstream sort of one. Figured it would be a good idea to get into the tax prep service business as it pertains to crypto. And then from there, I'm also an attorney. I went to law school while I was doing that and passed the bar. So helping a lot of crypto clients, not just individuals, but actual, protocols, NFT projects, kind of plan, structure, and strategize to make sure that they're in compliance with the IRS. And then I'm sure you guys talked about this before, upcoming regulations. It's really a tight space to be in on the law side. So it's very, very exciting to see how that's going to develop in the future. But of course, the main core competency of what I do is directly in line with the Coinledger team and CryptoTrader.Tax, which is reconciling these activities on a day-to-day basis so that users at Rocket Dollar or users on the CryptoTrader.Tax platform have the ability to know, like David said, where they stand in fiat terms from a tax perspective.
Great, thank you. And this is more of a fireside chat today. So I'll speaking to you, the customers and participants, people watching. Feel free to pop up questions into the conversation. We'll be doing a lot of back and forth here. So first question came in. What's the difference between CryptoTrader.Tax versus something like Ledger or Cointracker?
Yeah, it might have been me. Cut out there for a second, Brendan. Could you just ask the question one more time?
Yeah, what's the difference? We had a first question come up. Someone asked, what's the difference between CryptoTrader.Tax versus someone like Ledger or Cointracker?
Yeah, so very similar products, right? Similar to the cryptocurrency exchange space, right? There's a lot of people competing for this market, right? With now over 250 million global cryptocurrency users, it's a big space. So those are direct competitors of ours in terms of what's going to be different. Things like user experience, things like the level of exchanges supported, DeFi protocols, and then just how we build our business is ultimately different than them. But from a consumer perspective, there's a lot of overlap and a lot of similarities with those companies.
Great. And so when we start a crypto webinar, we always like to start like kind of 101, and then we'll expand into some more of these more hardcore complex topics because we've got a lot of hardcore customers. But we've heard, you know, people sometimes feel a little bit left behind if we jump right into the hardcore stuff. So could you guys kind of go over, you know, when someone's reporting taxes on their crypto, you know, this was a new world just a few years ago. How does someone do that? And what are some of the challenges? We have a lot of customers that use multiple exchanges, multiple DeFi protocols. How do you simply report crypto taxes? And how is some of that made more complicated?
Yeah, Jordan, maybe I'll just take a quick first swing and then you can fill in where I miss. So the way I like to explain it to people is cryptocurrencies from a tax perspective are actually very similar to equities or stocks, right? Which most people have more familiarity with. And so that's why I like to draw the parallels in that. In the same way, if you buy Apple stock for $100 and then it goes up in value and you sell it maybe 6 months, maybe a year later for, let's say, $250, right? That $150 gain is a capital gain, and that's a form of income that is taxable. And so depending on what your tax bracket is as an individual, you'll pay a percentage tax on that $150 gain. The exact same applies to Bitcoin, Ethereum, and all other cryptocurrencies, right? If I buy Bitcoin for $1,000, I put $1,000 in Bitcoin. Let's say it goes to 10,000 and I sell, or maybe I trade into another crypto and I realize that capital gain of $9,000. Again, that's a form of income for me, and I'm going to pay a percentage tax on that income. That's how they're similar. Where this gets fundamentally different is the technical nature of these assets. Equities and stocks, they're not interoperable, and they were never built to be fully interoperable like digital assets are. So in the equities world, right, it's not very normal for me to go and take my Apple stock and transfer it from Robinhood to E-Trade to some place to go and arbitrage on it or to generate yield on it from a different platform. And that is very much the case with crypto, right? Because I can self-custody, I can buy Bitcoin from Coinbase, I can send it to BlockFi to earn interest, then I can trade it for Ethereum where I can go and take it to Compound or Uniswap to generate yield. As these transfers happen, right, from platform to platform, now those platforms, Coinbase, BlockFi, struggle to actually report what your gains, losses, and income was because they only have a piece of the puzzle of your larger transaction history. And so that's why, you know, when you get a transaction report or a 1099 from one of these entities, BlockFi, Coinbase, at the end of the year, you might have seen that's very inaccurate and it's missing a lot of important information. And so that's where this differs, right? Because to actually reconcile and figure out how much have I made, how much have I lost while I'm investing on all these different platforms, I actually need to reconcile everything together so that I can track my cost basis as it moves from platform to platform. But at the end of the day, you know, the tax rules are pretty simple, right? It's gains, losses, and income in some way, shape, or form. It's just actually tracking that. That's where it is a little bit difficult. So that's how I like to explain the high level. Jordan, I don't know what you would like to add on. You can go much deeper technically on the tax side than I can, but feel free.
Yeah, I mean, there's really not much to add. David did a really good job of explaining at a high level how these transactions are tracked and how they're taxed. And if we're doing like a 101 intro crash course into that sort of operation, you have to just know that maintaining adequate records is the most important thing, because if you are someone that's just trading on a centralized exchange, that's fairly straightforward, obviously. Sometimes we have people that have engaged in centralized exchange activity dating back to, pre-2018, where they're no longer have access to that exchange or the exchange doesn't exist. And that gets a little more complicated. But people that have onboarded in like 2020, 2019, 2021, they tend to have all of the historical data for all their centralized exchange activity. But what David was saying because they don't really talk to each other, right? Coinbase doesn't talk to Gemini, which doesn't talk to Kraken, and allow you to know what the underlying basis was on movements in between centralized exchanges. It creates that added layer of complexity where you need to leverage a platform like CryptoTrader.Tax to aggregate that all into one portfolio. And then when you add some DeFi aspects to your transaction history and you're LPing, right? You're providing liquidity. Maybe you do some swaps on some of these decentralized exchanges, or even more importantly, when you're bridging, like David was saying, interoperability, right? When you're bridging assets across different ecosystems, that's when it can get a little more complicated. But you need to just make sure you're tracking the wallets that you're using then in that case, and not just the centralized exchange activity, so that you can go back and recreate that data set so you can, reflect it on a tax return.
Yeah, and something I want to press to the viewers here today is that, these transactions that David and Jordan are talking about, if you're a hardcore crypto person, you've probably done a lot of these wallet transactions already. If you're a newer crypto person, you might have thought about doing your first wallet transfer. These are very quick and high velocity compared to old school finance. So finance is kind of okay at moving cash from place to place. It's frustratingly slow, but they can still move cash. They are very bad at moving assets around. So moving a Facebook stock from one IRA to another takes a long time. They can be weeks on end, especially when they're busy. When the election chaos was going on last year, people are being like, it's taking a month to get my assets moved over. And we often get questions like, hey, can I move? I use another competitor, Rocket Dollar. I kind of want to be done with them. I want to move my crypto to Rocket Dollar. There is no infrastructure like there are for stocks, so even less infrastructure to move crypto from one IRA custodian to another. IRA custodians are not very good at moving a real estate property or precious metals from one custodian to another. And oftentimes I tell people is, look, you probably don't want an IRA custodian handling your crypto keys anyway, because most of them are not sophisticated enough and have that crypto knowledge that you do to be able to handle moving crypto from one place to another. So we get a lot of customers that have balkanized crypto experiences. Their taxes are all over in one place. Then they're trying to create a totally separate IRA universe and track that. They can get a little bit overwhelming. Okay, so we have, just a question came in from a few people. Does it cause a tax incident if you sell assets with an IRA LLC? The answer is no. You do not pay any capital gains. As long as it's inside of an IRA, you do not pay any capital gains. Rocket Dollar does not have any internal lawyer, but our $15 a month fee renews the IRA, renews the LLC. Make sure you have continued service for that. So, why a lot of Rocket Dollar customers are coming to us is to avoid capital gains and sometimes to avoid tax complexity. Some protocols, some things, it's just very complex. And with looking at DeFi now, there's a lot of things that we're not even sure how the taxation shakes out in that, correct? Yeah, totally. I mean, there's only been so much guidance issued by, the IRS and Treasury and folks. So a lot of the DeFi activity, as you mentioned, we just have to draw parallels with how it's treated in the traditional finance world and going off the limited guidance that they've given on cryptocurrency. And then typically go with kind of the most conservative approach. If you want to get a little bit more aggressive in terms of how you're going to treat your income from crypto, right? I would meet with a tax attorney like Jordan, right, who can kind of walk you through the positives, the negatives of maybe taking certain approaches. But yeah, it's frustrating because regulators move slow, right? We're a tech company, we're trying to move 1,000,000 miles an hour, and they don't do that. But yeah, there's still a lot of gray area in the space. Yeah, we have to look to precious metals and gold rules a lot to try and give crypto investors some type of guidance. So just so you know, at Rocket Dollar, we do not have a CPA on staff. We have a lawyer and CPA that we can refer people to, but sometimes it's hard because you go to these very experienced lawyers, very CPAs, they're great at precious metals or maybe real estate law, and they're just not up on crypto yet. So it's kind of like you have to bring together almost a team of people to come to these answers for these questions. Just, we stew on this all the time in the back end at Rocket Dollar but there's only so much we can share. You know, if we're not sure on something and it's scoping into legal and tax advice, we have to say, look, in the interest of the customers, we have to stay quiet on this until more of this stuff becomes clear. Luckily, though, there's more people trying to comment on it, more people trying to relate that stuff from precious metals to cryptocurrency. And thankfully, since the IRS does have tons of case law on real estate, tons of case law on equities, tons of case law on precious metals, we can take that and get at least somewhat of a path for customers to try and stay compliant, but we cannot obviously predict everything that they're going to do. So, Jordan, anything to add on that DeFi there with all those new protocols coming out and that mystifying of taxation?
Yeah, I mean, it is, like David said, and like you were just saying, it is kind of a gray area. It's an area where a lot of these cases, if they were to come to, let's say, tax court, would be, kind of an area of first impression, even though you can rely on things in legacy financial markets, or like you even used, precious metals or real estate to try to draw parallels. But most of the time, the main issue that people have, and it's not understanding, it's what type of tax position should be taken, is more so with wrapping of tokens, right? When you're using, let's say, like a protocol like Aave, and you're using, you want to collateralize some of your ETH, and you go into those AETH tokens, is that a taxable event? I get that question, or I used to get that question all the time for 2020 taxes. Now in 2021, it's more cross-chain bridging and NFTs, but you'd get that question all the time. And it's like, we don't know definitively, but if you look at it, it kind of looks like a token swap, right? You're changing the form of the asset. You're also kind of changing the function, even though it's on the same chain. It's still an Ethereum-based token. But maybe it is something that you just have to do it in order to collateralize this asset in the DeFi protocol. So maybe it shouldn't be treated as a taxable event. We don't have the answer. It's something that you have to take the position, be able to substantiate that position based on code law, maybe reg sections, maybe case law, and then be firm in that position. And ultimately, at the end of the day, stay consistent with it. Because if you choose something that's going to maybe benefit you, or maybe it's detrimental, I don't know, but you want to take a certain position in this year, you shouldn't go ahead and change that position in future years. You should remain consistent throughout the entirety of the portfolio's lifespan. And that's really what we mostly focus on, is staying consistent with those positions that you're taking. And then, of course, as more things pop up, more transaction structures come about, there's maybe an opportunity to take a slightly different position because the structure is different. But that's where the questions usually lie. It's more so collateralization of the assets and bridging and wrapping tokens, because the other things are fairly straightforward in terms of understanding how it's going to be a taxable event or not.
Yeah, and we had two questions come in on more on the retirement side that are related. So both David Boyle and Trip Dressler asked something, I'm using an IRA. Why do I have to report, keep records of anything? And the answer is kind of related to what David and Jordan said. Hey, if you're on a centralized exchange, it's probably very simple. You don't really need to keep any advanced records. You don't need to do any extra work. But we have a lot of customers that ask about going off the exchange, going off into hardware wallets, going off to DeFi protocols. As soon as you leave that centralized exchange, the exchange has registered your LLC. Their compliance department has looked at it. They've checked that it's registered at the state of Colorado. They know it's a real LLC. They've gone through a know your customer check, which is really established in finance. It happened after 9/11. All of these financial regulations came out, and it basically said, you have to know who you're sending money to and what your customers, like what they're doing on your platform. So a centralized exchange has done that check with your LLC. If you go off the exchange, this is where you really need to be much more diligent about records, because the whole purpose that you're in a Roth IRA is you don't want to pay taxes on it. If you have 5 personal wallets and 4 retirement wallets for your Roth IRA, what happens if the IRS agent walks up to you and they go, I don't believe these are all personal wallets? What are you going to do? Do you have sufficient evidence and records to disprove that? Do you have stuff that you're going to commonly be able to easily present? Is it consistent? We're not sloppy with it. Can you quickly bring that up and have a good explanation for why these 4 wallets are all connected to your Roth IRA and your Roth IRA only? People ask, well, there are blockchain records. Crypto hardcore universe always thinks about that. Hey, I have a blockchain record. I don't need to worry about it. However, we don't know how the IRS is going to see a blockchain record. Are they going to respect all of them? Are they going to respect some chains and be more hesitant on others? Some people using like privacy scramblers or stuff like that, or privacy coins. And how nicely will they see things as they get farther and farther away from a centralized exchange? So we talked a lot about this, some of the tax enforcement, tax court themes in the part 1 webinar that we did with Regiment and Matthew Metras. And a lot of that is when you go into tax court, you got to be ready to defend what you're doing. Like Jordan was saying, staying consistent from year to year. If you're sloppy, if you have terrible records, if you're careless about this stuff and you get into tax court and you're asked to defend something for your Roth IRA or your taxable crypto, and you don't have good answers for that, and you have a totally sloppy defense, you could get your IRA invalidated and pay taxes on all of it, or you could get terrible tax penalties. I don't really, that'd be more David and Jordan would know that you're forced to pay. So to summarize all that, centralized exchange, don't worry too much. If you're thinking about doing anything off the exchange, the IRS has no laws against that. You can do it. You just got to know there are risks involved. And when you're ever in a new gray area, you got to keep good, careful records. Okay. All right. Someone asked, are staking gains trackable and tax reported using the CryptoTrader.Tax software platform?
Yep. Yeah, it's no problem. Just connect wherever you're staking to, whatever wallets you're staking to. If you're doing it through a centralized entity, you're going to connect up an API or drop in their transaction history file, but that's all built out in CryptoTrader.Tax.
Yeah, and just let me know a little bit about your guys' cycle of what you've been working on. When you first started the product, what did it have? And then, as these new crypto features are coming out, I'm sure you already worked on staking before. Like, what order have you been working on adding new features?
Yeah, great question. When we started the business, the crypto landscape looked a whole lot different than it does today. It was predominantly centralized exchanges. There was no lending markets built out in crypto. It was all spot markets. And so the product was much simpler back then in that all it really had to do is connect to Coinbase, Binance, call it all the exchanges, pull together that transaction history. And that's the product. Now, as the crypto market has matured, and it will continue to mature at a faster and faster rate as much more human capital, real capital gets pulled in and invested into this space. And so with that, we've had to grow how we support all these new offerings. So whether it's lending markets getting built out by the Celsiuses and BlockFis and Nexos of the world, then now this year we go into past 12 months, DeFi has exploded, NFTs, right? All of this stuff presents taxable challenges. And so we've just had to continue to build out integrations with all of that. So the current CryptoTrader.Tax platform is predominantly still focused on those centralized entities. As we roll out Coinledger in the next month, that's going to be very DeFi native, right? Just put in your public wallet address. We'll import all of the transaction history on chain and properly classify, your LPs, staking rewards, swaps that you've made, NFT buys, NFT sells, and we'll pull in all of that on-chain data and classify it for you. That's completely free to use, right? You talk about just having good records. Coinledger will be a great just ledger tool that's completely free to use. Again, if you want to generate your tax reports with that data, then you can pay us to do that, but you can also just use it for free. But to answer your questions, we just have to evolve with how the market evolves in terms of how we support the various products.
Great. Yeah, I thought that because it's kind of the products that you have to make, it's kind of showing the growth of the crypto space. Your customers' needs are evolving at the same time the space is exploding.
Yeah, exactly. So it's a unique challenge because the space is speeding up, right? So it becomes a technical challenge. And you're seeing this across every company in the space, right? How do you scale product development with the pace of market growth? It's not easy, right? It's because humans don't scale as fast as, the market, but, we're getting a lot better as everyone else in this market is, and everything will continue to become just more and more seamless.
Yeah.
And that's not just in tax. That's, I'm sure, for the IRA products too. You guys experience the exact same things.
Yeah. You know, every few weeks, someone will be like, have you heard of insert name here protocol? And I'm like, nope, you're the first person to ever mention it. So you're Mrs. Customer, it's your job to teach me about it. And thankfully, everyone's been really good at teaching me about that. That helps me keep up with everything. So tell me about, you know, the growth of NFTs. How has that been hitting your guys' business and also the space at large?
Yeah, so right now we don't support NFT tax reporting. That's again coming with the Coinledger, which is all the on-chain aggregation services. But we've seen just an absolute explosion. I think it's insane. Just our customer service chats have been nonstop. You know, can you guys help me with my OpenSea trades? All of that stuff. And so, you know, just like you mentioned, Brendan, as people come to us with more and more stuff they want us to support, we have to prioritize with, you know, our constraints, and the NFTs is one that's on the absolute top of our list. So, I mean, right now we have 4 DeFi engineers whose sole job is to build out support for all of that. But it's been amazing how fast those communities have been built. I guess that's what happens when you can make hundreds of thousands of dollars on a picture of a little crypto punk. Jordan, I don't know how you've been seeing it from the tax.
Yeah, so we've been having a lot of people ask questions about it, and unfortunately, you really should not be doing it in an IRA. You should keep NFT investing in a taxable account, and I'm going to pull up the IRS language here so people can read it, because people ask like, oh, you know, I can do it, but there's actually already a law against this. Just answering a mining question right now, and then I'm going to pull that up.
Yeah, Jordan, how have you seen it with your business taxing cryptocurrency, the NFT side?
It's like you said, it's just been a complete explosion. Earlier this year, 2021, having like wrap up calls with clients for 2020 tax years, trying to figure things out. A lot of them would be like, hey, I'm getting really into this NFT investment thing. Putting some spot ETH in here, and I'm going to buy a few things. Just like, do you have the ability to account for this? And I would tell them, right now, if you were using, you know, a platform like CryptoTrader.Tax, or if we were using like a tax professional version of that, we don't, because there's no way that these software companies are going to be tracking it. But I had a feeling that this was going to be something crazy, because I would say about 10 to 15% of my clients that were talking about this, and those were always usually the early DeFi adopters, the early altcoin adopters. So I was like, all right, I kind of have to understand this. So I would get involved and, you know, mint some things just so I could understand the process from a tax perspective, because unless you are in the NFT community, you won't really know all of the hurdles that there are, you know, a lot of taxable events that occur along the way. But I've seen an explosion of NFT related tax questions. And honestly, over the last 2 to 3 months, I would say about legitimately 75% of inquiries to the firm, whether law firm or CPA related, are NFT related or have some NFT aspect to their tax situation. And I think it's done a great job of onboarding a lot of people into this ecosystem, into the crypto ecosystem that otherwise wouldn't be invested in. You know, they're not looking for DeFi yields, or they're not going to Coinbase to get onto some centralized exchange and swap different alts. They actually are like into, and maybe they're into making a ton of profit, of course. Yeah. But a lot of them are actually into that community of whatever they're buying into. And so I think it's done a tremendous job of onboarding people. Then they tend to end up going to like the DeFi sort of aspect of crypto. But that's what I've seen. It's more of like an on-ramp for a ton of people that otherwise wouldn't be in crypto. And it's creating a huge market for people to either, you know, change their lives with investments, change their lives with providing art for people to acquire or mint, and ultimately, you know, help platforms like CryptoTrader.Tax provide a solution that others can't so far. So it's really cool. NFTs are great.
Yeah, that's so true. How many people it is onboarded who would not have been interested in crypto. It's wild. Just, you know, you have so many influencers, you know, athletes, actors, everyone's pumping, and it for good reason, right? It could change a lot of dynamics in business models in terms of music, art, right? And so that's very fascinating.
Yeah, a lot of those what might seem very silly crypto parts, like, you know, people made fun of Dogecoin and everything, all of a sudden, 6 months after someone's messing around with Dogecoin with $100 or $50 or $10, they're actually getting interested in the crypto space. I think it's the same with NFTs. Of course, there's some things that seem ultra silly, but then, people start really working out, okay, this is how I can make it work for my business. This is how I'm an artist. I can actually make some real money off this. Artists have been really struggling in the digital age for quite a long time. Now, some of them are finding reliable ways to get paid through that innovation. Something I want to bring up, though, is, again, doing the NFTs in your taxable account, because we've had Rocket Dollar customers start to ask, and we've had some NFT fans come in and ask those questions. There has been a law against collectibles in IRAs since 1982. And so this is my, big call. I'm not too confident on a lot of tax calls here at Rocket Dollar. Try and stay away from that. I believe the IRS will eventually distribute all NFTs from IRAs. If they find it in your IRA, I believe that they can push it out at a future date. There is no commentary specifically about NFTs, but what an NFT is evolving into is very close to what I would consider a digital collectible. So I just wanted to read the language here. The acquisition by an individually by an IRA account or a qualified plan of a collectible is treated as immediate distribution from such account equal to basically the amount of the NFT or the collectible. Exceptions apply for specific collectibles as discussed below. Those really only relate to gold, silver, and platinum coins. And blah, blah, blah. Plan's tax qualification under Section 401A is not affected by the investment in collectible unless the plan's provision precludes such an investment. So basically, people often try to buy classic cars through IRAs. They would try and buy antique rugs. They would try and buy baseball cards, which, there's already NFTs for like NBA. Now the MLB is getting into it. So you just got to know the IRS has never been a fan of collectibles. There's a lot of interesting innovation and buzz coming in NFTs. Stick with your taxable account. I think it could just lead to further issues. If you have a great IRA, you've done everything correct, then you have a bunch of NFTs, that's just going to get you heat that you probably don't want to deal with. So stick to that in your taxable account. Stay away from it in your IRA. When that is found in tax court, I don't expect they're going to be nice about it at all. And that's the most confident call I could ever make about anything in crypto taxes and IRAs.
Yeah. I would say, just to add to that, I would love personally to be a lawyer to argue that, these NFTs are not collectibles, but I would not advise somebody to take that position and say, you should do this. Don't be the first person to make that argument. There is an argument maybe in there with certain NFTs, right, that aren't necessarily collectibles, and you can paint a broad stroke and say all are collectibles, and it'd be fun to argue that position, but you don't want to be the taxpayer in that position where it's busting up your IRA, right? So I think Brendan's giving you some good advice, because ultimately there probably will be some code section changes to include that into the definition of what a collectible is. And yes, as a tax professional, we think about these things all the time. As a lawyer, I look to little words in code sections where, in that definition of a collectible, the catch-all provision says, any other tangible property. So maybe intangible assets aren't collectibles, right? You can make that argument, but you don't want to be that person to make that argument and have it bust, like Brandon said, your beautiful IRA account that's, accumulated a lot of wealth for you and preserved money for your retirement. Now, all of a sudden you have a tax penalty and nothing, it doesn't work. You work all this time. It's gone.
And the cheat code to that, I guess, is there's some people when they're in a gray area, they'll start a totally separate IRA. If there's ever a transaction, they're like, look, I've done everything by the book. This deal is a little bit gray area. The IRS technically says I can do it, but I'm not sure if I can do it. You want to do that in a different IRA. And we talk a lot again in the last webinar about going to tax court and what that's like. That's not for the average investor. That is not fun for the average investor. The type of people that go against the IRS lawyered up and, ready for that challenge, they're typically extremely well prepared. They have a buttoned up case and they have done everything ultra diligently. And that's the kind of person that you want on the line first in the line of fire. You don't want to be you don't want 3 IRAs that you saved up for 30 years to suddenly get blown up, because the problem is in IRAs. 401ks, a solo 401k, it's a 15% penalty. An IRA is a full death penalty on it. The whole thing gets kicked out. So even if you made a mistake with $5,000 to $6,000, according to the IRS, they can distribute 200, 300, 400, a million from the IRA if they think it's valid enough to go after you on it. Okay, Michael has a great question. I thought all cryptos were taxed as collectibles. Cryptos are property, Jordan, I believe?
Yeah, it's personal property. The collectible side of things, honestly, with NFTs kind of took off because people are deeming them to be collectibles. Like they're talking about them like they are collectibles. And arguably, if that wasn't the case, if it was brought into light in a different manner, maybe people wouldn't be discussing that, but they kind of are collectibles. They kind of are digital collectibles, but no, just like a token, like cryptocurrency, let's say, or something that allows you to leverage a platform or a protocol, gives utility. That's not necessarily a collectible at all. And it doesn't really fit into the definition of what a collectible is.
Yeah, and so I think, we're seeing the first NFT, a lot of I don't pretend to know all of the NFTs, but like CryptoPunks, David mentioned, that's like a very collectible type NFT. The innovation that keeps, running around the space very quickly, almost too hard to keep up with, is people are thinking of other uses for NFTs other than the basic collectible use. And Jordan mentioned that. Those are the ones that will probably, maybe in the future, get some flexibility. A just standard, I just have like the dunks of LeBron James or something like that. That's probably going to be collectible. You have to look for things that have more utility if you ever have a chance of arguing that. And that's probably if someone's trying to challenge the IRS on that, they're probably going to look for one of those more utility-based NFTs to see if they can actually get some flexibility in the law for those, multiple types of NFTs. All right, we had a few. Okay, 6 questions, quite a lot. What chains will Coinledger work with at launch?
Yeah, so it's all Ethereum based to start, and then we'll be expanding into Solana, Cardano, Binance. Well, Binance Smart Chain is going to likely be one of the first supported, but it's really by market demand. So the vast majority of support requests that we get are for Ethereum based protocols. So on launch, it's Ethereum, and then we'll keep going from there.
Okay. Yeah, all of our previous webinars are on YouTube. You can always find them up there. So there's a good question. I want to make sure we have time to discuss it. So the infrastructure bill. There's the crypto side of this, and then there's the self-directed IRA side of this. So let's start in the crypto side. And before we jump into it, let me just tell customers there are 2 infrastructure bills. It's been really messy in Washington lately. There is a bipartisan Republican and Democrat supported bill. And then there is a Democrat-only reconciliation bill. So bipartisan bill, reconciliation bill. Always know when you're thinking about impacts, try and figure out which one that's in, because if you're thinking, oh my God, the infrastructure bill is passing, there's 2 of them. So, the easy way to distinguish it, are only Democrats talking about it, or are the Republicans talking about voting for it? If it's that one, it's the bipartisan one. So David and Jordan, there was some, there's some language that popped up in one of the infrastructure bills. Could you please comment on that?
Yeah, me and Jordan spoke at length about this on another call like this. Just at a high level, first of all, cryptocurrency taxes are not changing, and they're not impacted for you, the individual investor, right, from this bill. This impacts businesses that operate and facilitate cryptocurrency transactions, right? My business, CryptoTrader.Tax, is not affected. We're not going to have more regulation. But businesses like Coinbase, like BlockFi, like potentially some DeFi protocols that facilitate crypto transactions, whether that's trades, swaps, earning interest, whatever it may be, there's language in there that's going to capture them as a broker, which is going to potentially require them to report 1099s to the IRS on behalf of that activity. So again, bringing it back to the world of equities, like I did at the start of this call, it's very common, right? If you have an E-Trade account, a Robinhood account, right? Those are registered brokers. if, I buy, sell stocks through Robinhood, at the end of the year, I'm going to get what's known as a 1099B, 1099 brokered form. At the end of the year, that details my gains and losses from my stock trading activity. That's easy enough. I give that to my tax professional like Jordan, and, they use that information to calculate how much income I made during the year. That doesn't exist really right now in the world of crypto, right? Coinbase has been giving 1099Ks previously, right? But there's been no clear cut, what type of 1099s are required. So what this infrastructure bill is trying to capture is it's requiring this level of reporting for, brokers like Coinbase. Now, again, where this does impact cryptocurrency users is just the IRS is going to have a lot more information in the future on who is investing and transacting in cryptocurrencies, right? This is going to drive a lot more enforcement and a lot more compliance, because if the IRS gets a 1099 from BlockFi or Coinbase or whoever, and they get it, hey, David, here's his 1099B, and I didn't report any gains, losses, or income in crypto on my tax return, that's automatically going to trigger a flag, and a letter is going to come out to me being like, hey, David, we have records that you have some type of crypto income, but we don't see any on your tax return. So it is, people always tell us taxes are, crypto is fully anonymous. How are they ever going to track this down? Well, this is one mechanism they're going to start using to track down, hey, who should have some type of cryptocurrency income on their tax return. Jordan, it'd be good if you fill in holes with where I missed things.
For sure. You covered a lot, and that was actually a really good intro into this bill, or into these bills. The main thing that people, like individuals or even entities that are trading on these platforms or in leveraging DeFi protocols, have to understand is that in theory, there already is a way to track all of your centralized activity to your decentralized activity by just a simple on-chain analysis, because that, even though it's anonymous, right, it's not really. If you have a KYC'd account, Brendan was talking about that earlier, know your customer. You have a KYC'd account and you transfer funds to a non-KYC'd unhosted wallet, in theory, there are firms that can easily see that information and be able to report that, hey, this wallet might be tagged and associated with this particular individual. But there won't really need to be the need to do that if this new broker rule is passed, because all of these centralized exchanges are now just going to bulk data dump information to the IRS. It's not going to be accurate because they don't have the ability to track cost basis. But at least, just like David was saying, they're going to know that these people have crypto, they have assets that they're holding. And therefore, if they don't report the decentralized activity that they think is, it's just on chain, but it's not tied to their address, they're putting themselves at risk for, not telling the truth to the IRS, which is, no one wants to be in that situation. And so that's kind of what this is doing to the centralized authorities, who honestly have the ability to just issue these forms anyway. They have the money, they have the capital to create the infrastructure for activity that occurs on their exchange. And they should honestly be doing that. What it does do, what David mentioned also, is it could be somewhat of like a backdoor regulation of DeFi, and honestly kill some innovation in that space, because there's no way that those protocols, who are just the people that have developed them, have deployed the contract, deployed the protocol, and now they're not, in theory, technically, they shouldn't be operating or making any decisions. So who's going to be responsible for reporting that information to the IRS? No one really can. And that's why we were trying to get those exceptions for what the broker definition was. And that's really looking at it from just purely the broker side of things and that definition for reporting requirements, which, again, I think David covered really well. The other side of the potential infrastructure bill change, or the other side of the potential changes, which I'm not sure if was talked about on the last webinar, was the change to the wash sale rules. That is a huge change, because it's not really a tax loophole per se, but as of now, you can kind of sell off losers and repurchase them back, as long as you're doing so in a manner that looks like a reasonable transaction. And that could go away with a specific change to the tax code to implement crypto. They're not calling it crypto, they're calling digital assets, or whatever their terminology is, digital assets, in the wash sale rules. And that's another part of it that will affect taxpayers. But the broker definition, which is where everyone was talking about and fighting on crypto Twitter, on podcasts, on YouTube, or whatever, that main issue is more, in my opinion, like a backdoor regulation of people that otherwise shouldn't be forced to comply or wouldn't be forced to comply with reporting requirements, which at the end of the day is a data aggregation exercise.
And Coinbase, Coinbase has, like Coinbase or Gemini, these bigger exchanges, like they have enough compliance people to eventually get through these changes. Sometimes a DeFi protocol is just, is it 5 or 6 or one programmer that has made this? And,
where it's domiciled, where does the activity actually occur? It's not a good situation to include like a broad brush for what is a broker. There should be specific carve outs, and it shouldn't be, one sort of, like proof of work is better than proof of stake. And like, it shouldn't be like that. In my opinion, I think it should focus on the centralized authorities. But again, I'm not a policymaker, so I don't really have a say. We just have to do what's required of us. So it is what it is.
There is a blockchain group of Congress members, and I would highly encourage to look through that list, see if you recognize any in your state, or maybe just in a nearby state. Applaud those people for being part of that conference, and also bother if your local congressperson or senator is not paying attention to these rules. Say, hey, why don't you go stop by in Mr. or Mrs. office down the hall? I really learned about these provisions, because I think it's about 30 people in Congress. I don't know if they have a single senator, but those people will be able to educate other people in Washington to put more effective rules in place. And I believe the crypto language, I'm just double checking online, I think it's a bipartisan vote. It was 69 votes in the Senate. So that is the bipartisan infrastructure bill that the crypto provision is in. And so Kirk Caldwell asks, and then I'm going to jump into the IRA side of this, is the new legislation forward or backward looking? Typically it's forward looking, unless it's this current tax year. Can you answer that?
It's usually there is precedent to have retroactive changes, but that's not typically what we look at when we have these tax code changes. And even, in fact, a lot of these changes aren't going to be in place until like the 2023 tax year. The wash sale rule that we were discussing is at the end of this year. But some of the changes aren't going to come into play, obviously, until 2022 at the earliest. There was some discussion about them trying to backdate the change and potential change in capital gains tax rates. But again, we don't have definitive information on that as well. And it tends to not be the case when they have policy change in tax. It's usually prospective.
Rule of thumb is expect future change or expect near future change. Don't worry too much about what you did in the past. Start trying to comply with what's currently coming out. So now I'm going to cover the IRA side, which is a whole mess of its own. And this is in the Democrat-only infrastructure bill. So they're totally separate than the bipartisan one. So let me just bring up so people can see. I'm going to put the two bill provisions here. I don't have nearly enough time to go over all of them, but so I'm going to put them into the chat sections. Build back better. Okay. And so these provisions talk about a few rules about accredited investors. And they talk about investing in companies that you are the manager of. Now, just so everyone knows, I watch politics a lot. I'm always reading political news literally constantly. So I just, seen these song and dance before on these things. There's someone called Joe Manchin and Kristen Sinema. They argue a lot and they gatekeep a lot of things that are going into this bill. So this bill is still pretty early in the whole scope of Washington. The infrastructure bill got pretty far, got through the Senate, and now Congress is working on it and talking it over. So these sections of the bill talk about an accredited investor. They talk about what can be an IRA investment. And it's mostly in a response to what Peter Thiel did. It's a little bit of a knee-jerk reaction, in my opinion, of, Peter Thiel had a very successful giant big Roth IRA. So there's some restrictions on Roth IRAs for people over $400,000. There's some restrictions on if it's an accredited investor investment, can it possibly not be inside of an IRA? There's some rules if you are a manager or officer of a company, can it not be inside of an IRA? So definitely talk to your senator, congressman, call them about these provisions. I just want to let customers know this is a long way before this actually gets passed. The crypto language seems like Senate was done with it. So Congress now has to go and debate it. The infrastructure bill really has not gotten down to a granular line by line level. You just hear this $billions of here, this billions, climate change. They're not really arguing specific provisions of the bill. They're more arguing overall themes of the bill right now. After that, that's where they really get down to the down and dirty. That's where they actually start, trying to get certain provisions struck or rewritten. So I really suggest, if this is a petition, I can throw it in there. If you are concerned about that, if you want that freedom with a self-directed IRA, our opinion at Rocket Dollar, we're going to have a great blog coming out about this probably next week, is just how to get involved, how to talk to your senator about that, because we don't want anything to happen to the freedom of the IRA LLC or possibly have a taxation issue for our customers. If there is something, just know, if the worst case scenario, if this passes, there are 2 years to comply. So if you saw an issue with an investment, you'd have 2 years to figure it out before anything happened with it. And we've been communicating as well, hey, there's a lot of small business owners. There's a lot of people that use our accounts that are well below $400,000 a year. If we have any customers that make that much, it's very few. Most of our customers make $70,000, $80,000 a year, maybe 150 with them and their spouse. So really communicate on this. Feel free if you want to sign the petition. We're going to have some more action coming out on it next week. That's more actionable. And I really encourage you, if you are interested in this, call your senator, call your congressman about the crypto rules or the IRA rules. I worked in a political office back in the day in Wisconsin. Calls are always number one. Listen to the most out of anything. Specific emails are listened to the second amount. Petitions and forum emails, I'm going to put this petition so you can kind of find the links and understand the issue more, are usually kind of ignored unless there's tons and thousands of them coming in. So feel free, throw a call to your congressman or senator. Takes 2 minutes. Those people do record what the issue is about. Even if you don't hit the actual congressman or senator, there is an employee that writes down what that person was talking about. Are they pro or for a certain issue, or want a closer look at it? The congressman or senator does get a list of stats of, hey, I had 20 people call this week and ask about the crypto rules in the infrastructure bill. That's going to inspire them to take a closer look at it. All right. All right, and let's see, we've got other questions here. Someone asked about a Terra station wallet. Do you guys work with Terra at all?
Nope, not at this time, no. Okay. But ping us, we'll look into it.
Yeah, and I talked to one guy, he had used like almost every crypto tax reporting software, and he's like, my needs aren't being met. I've tried them all. And I just say, look, hit up David's team, talk to them, tell them what you're frustrated about. They're always actively, working on features every tax year to bring new features for the customer. Okay. All right. We answered the big IRA infrastructure question. Tax trader quotes a certain number of trades per tax season. Is this in a tax season or a fiscal year?
It's in the fiscal year. So it's, January 1st to December 31st. That would be your year, right? Which is, if I'm going to pay taxes here by April, that would be for my 2021 activity. Okay. If that makes sense.
All right. And David actually just put a link to the Congressional Blockchain Caucus. So this is the group of Congress people that we were mentioning earlier. I just put it in the chat. Feel free to review that. Feel free to Google them and either encourage a member to join or just go and get educated from them. Some senators and Congress people, they're just too old. They're not ever going to get it. But maybe you can convince them to defer to that caucus, pick up the phone saying, hey, I don't understand these crypto rules. How should we vote on this? And then if they give a much more educated answer, that's going to help your congressman or senator give a much more informed response. Great to publicize that, David. Thank you. All right, Eric Reed, are there limits for an SD IRA are the same as traditional and Roth IRA limits? Yeah, so Eric, traditional and Roth IRA, when you're investing in crypto, most of the same IRA tax rules still apply. So like a $6,000 contribution or a $7,000 one if you're over 50. rollovers, conversions, all of those basic tenets you can think of when you're using equities still apply to a self-directed traditional or Roth IRA investing in crypto. The more complex differences start to happen when you go off the centralized exchange. That's why we do these webinars, and that's why we go into the really hardcore topics. All right. If you're trading crypto in a given year, do you have to pay the gains and losses the next year, or does it wait until you cash out to fiat? A question from Larry. Jordan.
It's a good question.
Jordan, go for it.
All right, yeah. So all the activity that you have, let's say in a given year in 2021, you could have to pay tax during that year in estimated taxes, so you can meet the safe harbor and you don't have any underpayment penalty. But how it technically works is all the activity you've engaged in, and that doesn't mean just swapping back to USD and withdrawing to your actual bank account, but crypto to crypto, crypto to NFT, NFT to NFT one-of-one swaps. All of these things trigger taxable events, and you aggregate that data on a platform like CryptoTrader.Tax or in the future Coinledger. And then at the end of the year, you have a baseline level to know where your capital gain or loss is. You know what maybe some profitability is from yield or staking, or maybe you're mining, whatever you're doing. And then when you go ahead and file your return, the subsequent year is when you pay the tax for what happened in the year prior. And that's kind of how it works for all sort of tax related income, right? For your W-2, you don't file a return in 2021 for 2021 W-2s, you file that in 2022. So it's like the same sort of concept, but you just have to make sure that you're aware that it's not strictly crypto to USD that is what's taxable. There's a ton of other taxable events that could arise during your investment timeline. And that's why having a platform like CryptoTrader.Tax or somewhere that you can aggregate that information and keep it and consolidate it will pay dividends in the future. So at the end of the year, you're not scrambling to figure out where you stand, what you did, and getting down to the wire on the tax line, the tax deadline. I see there's another question, like I said, quarterly taxes due. It just depends. I mean, if you have a huge portfolio and it's going to bump you up and your AGI is going to be well above what you get from like 1099 contractor work or your W-2, then in theory, you should pay as you go, right? But investments don't have that withholding. So you're not paying as you go with automatic withholding. You would have to calculate that information yourself and pay estimated taxes. And that could be based on current year income or prior year income, so long as you can meet that safe harbor limit. So you don't have any of that underpayment penalty, which could be annoying to deal with if it's unexpected. If it's expected and you know that, and you want the capital available so you can invest in other things, and you're maybe willing to pay the penalty, that's fine. That's a personal decision. That's not something I advise against or for, but you don't want to get into that unexpected area where you didn't know you had to make these payments, and now you have a 2.5% penalty on top of whatever you owed. So.
Great. Yeah, we're getting close to an hour. Are you okay going a few more minutes? But we're going to kind of the viewers, we're going to try and close up in the next few minutes here. So we had a question, is there a specific date when these bills are to be voted on? Again, with me watching politics, there is no hard date, but the way these things go is the pressure builds up and then the vote comes. Currently, Joe Biden said, I think it was before the end of the year, October. Now it's like probably, I'm guessing, Thanksgiving. There's a lot of pressure on Joe Biden to push Democratic Congress to get these bills done by the end of the year. Elections are coming up in 2022, and it's a slim majority. So Joe Biden knows that they need to get a couple landmark bills done before elections. So if they don't get this done by the end of the year or the holidays, this will be horrifying for their strategy, because then they won't be able to concentrate on anything else until 2022. So I see the make or break point in probably Thanksgiving and Christmas. That's when a lot of senators go home. That's when they leave Washington. And the pressure kind of builds up to where they're not doing anything. They're hemming and hawing. But when that date comes, when they're going home, they stay up all night. They get it done, or it gets voted down. So I would really put a comment in, send an email to your congressional congresspeople and senators before Thanksgiving. So send it today, send it tomorrow. It takes 5 minutes. You can hit 3 people in 5-10 minutes because we'll have a make or break by the end of the year. It's my best guess. And all right, last call for questions. We're going to try and finish up and get everything here, and then we're going to close out the webinar. Someone just said they're going to try out, Larry said they're going to try out CryptoTrader.Tax. Awesome.
There we go. One new customer.
It's likelihood that policy leads to an unrealized gains tax being payable. Yeah, so, an anonymous attendee is asking, hey, would this lead to some unrealized capital gain having to pay tax? Go talk to your congressperson or senator about it. There's been a lot of political pressure from Joe Biden to say, hey, no one under $400,000 a year is paying you taxes. That has been a huge tenet of the current bill. Now, when the Democrats, they want to keep that. The Republicans want to pressure on that. So if you bring that up, I've called a few Texas people lately, and I said, look, if you're a Democrat, Mr. or Mrs. Congressperson, Joe Biden said we're going to keep these, anyone under $400,000 a year should not pay taxes. If it's a Republican, just mention that. They're probably going to start blasting all their colleagues about it, and they'll bring it up, and the Democrats will be more pressured to change that. So some parts of the bill are so blunt. Jordan was talking earlier, there's a lot of non-specific language that almost in a weird way encourages me to silver lining that there's such blunt language, because that forces them to come back and look at it again. If there's ultra blunt language that's not very clear and kind of getting a bunch of unrealized consequences, yes, that sucks when that law passes, but that makes sure that Congress people will look at it carefully before it passes. They will revisit it, and they'll try and put future clarifications on it. So some of those unrealized gains for self-directed IRA investors, go bring that up right now. I was just on the phone with people 2 days ago, and they said, that sounds pretty ridiculous. They seemed really receptive to that message, that should be looked at more carefully. It sounds ridiculous. Bring it up, because then your representatives know about it and can attend to that need. All right. Okay. Anything more in the chat? Chuck also asked about yield. I think you already kind of covered that through your quarterly tax.
Yep. Yield is taxable, and you owe taxes, pay taxes the following deadline.
Yeah, and yield is taxed as income, correct?
Correct.
Exactly.
Yes. Yeah. And
there's a lot of nuance into how you're generating that yield, but yes, overall, it's taxable income. It's ordinary income.
Yeah, so Trip Dressler, I think we answered the question. Coinledger.com's compatibility with other chains. You guys said Ethereum, and then you're working on other ones after that?
Yep, Ethereum base chain, and then it'll be Ethereum side chains next, and then we'll look into Solana, other chains based on market demand. So ping us if you want one supported, and we'll look into it.
Awesome. All right, David and Jordan, thank you so much for coming. Will you please put your email or somewhere where they can get in touch with CryptoTrader.Tax in the chat right now? We'll read that out, and then we'll close up the webinar here.
Yeah, so we have a full big customer support team, so they're going to get back to you if you email help@CryptoTrader.Tax.
Yeah, it's great is we're just about to show our new Rocket Dollar team page. If you check the About Us, we've hired up quite a bit more now. We're about to 25 employees, and we're continuing to really grow. We're going to keep growing a lot over the next year. So there's, we had someone come on our support staff a few months ago, earlier this year, and then we now have 2 new salespeople that are joining up with us. So really appreciate the growth that we've had. It's been great to work together. Thank you so much, David and Jordan, for coming out today.
Yeah, thanks for having us. It was great. Thank you.
Yep.
All right, and this will be on YouTube. I say every email, it's gonna be on YouTube. It'll be there. Just check in 1 hour. That's where the recording will be. Try and tell all the people that keep emailing about it that it's on YouTube. All right, thank you, everyone. Have a great day.
Thanks.
Thank you all.
Take care.